Taking it back to Carlson. He's free. He's in.
We got a whole new ball game, Matt.
"29-yard touchdown run. Ben Carlson, 21st touchdown of this, his junior season." And you
Welcome to Ask the Compound. Our email here is askthecompoundshow@gmail.com. Send us an email if you have a question, if you have a comment. Someone in the live chat just said I have skinny legs. That is not true. I do not skip leg day. Thanks to all the people in the live chat as usual. Today's show, we're answering questions on advisors who add alternatives to their client portfolios. I'm going to use a football analogy. Timing the housing market when mortgage rates refuse to come down anymore. How overvalued the U.S. stock market is right now. Dealing with the psychology of investing mistakes. And when the best time for bear markets is in your investing life cycle. Today's Ask the Compound is brought to you by Public. Fed is lowering interest rates. Eventually, it's going to seep into the bond market. It hasn't done so yet for Duncan's long-term bond hold. But you can still lock in 6% or higher yield at a bond account at public.com. Not bad. They're investing in corporate and high-yield bonds. The great thing is that these are individual bonds, so you can lock them into higher yields. So other people are watching the returns shrink and the yields shrink. You can sit back with your regular interest payments. We don't know how long these yields are going to be here for. They might not last forever. 6% or higher yield with bond account at public.com. Check out public.com/ATC. Again, that's public.com/ATC.
We love Public.
Yeah, great service.
Great app.
Buying a bond on your own is not easy.
Speaking of gyms, I had a gym experience at a hotel in Chicago yesterday, actually. Do you ever just walk into a gym and just go, nah, just based on the people that are in it?
Well, usually if I'm at a hotel in New York, the gyms are very tiny. It's like the size of a dorm room in college. So if there's someone in there, yes, I'll...
They're just some like judgy guys. I was just like, nah, I don't have time for this.
Okay.
Yeah, I don't know. Maybe you're the judgy guy.
Maybe you were being the judgy guy.
Yeah.
All right,
Yeah,
do a
sure.
question.
All right, up first today, we have a question from Andrew. My advisor is a big believer in diversification, as am I, but I think they've taken it too far. In addition to stocks and bonds, they have me in long, short funds, managed futures, market-neutral strategies, and a reinsurance fund. I don't know what that last one is, so I need you to explain that. I don't mind alts per se, but A, I'm not sure I understand how all of them work, and B, I'm worried this is just complexity in the name of diversification. What do you think?
All right, so a reinsurance fund is just you're investing in a fund that will give you the premiums from insurance companies. And the hope is that, yes, some years there's going to be catastrophes, as we've had this year, but other years there won't be. And I think 2023 was a really good year for these reinsurance funds where you just bring in all the premiums as that's your return. It's very lumpy. Some people like these. I didn't really want to even focus on the strategies here, though, because the strategies are irrelevant in my mind. So my son has played flag football for the past 3 years or so. It's kind of fun. They give him NFL team names and jerseys and such. Pretty laid back beyond the handful of psycho parents and the occasional coach that goes too crazy. But whatever, it's a good learning experience for him. I like it. The 8 a.m. games I'm not a fan of, but all in all, it's like learning the basics, right? He's young. But the thing that gets me always is the complexity of the coaches that come to these games. And it's always the same for every team, whether it's my son's team or someone else's team. These coaches show up with a huge 3-ring binder of plays, right? Huge play sheets, right? Mind you, these kids are 7 years old, and we're talking, if you can get them all to listen at once, like you're doing pretty good, because boys are animals. They really are. They're constantly messing around. They're pulling each other's flags off. They're making obnoxious like fart jokes. They're talking when they shouldn't be. They're pushing each other and tackling each other. Boys are just literally animals.
Sounds like a good time.
Yes. So like getting them all to just pay attention to you for 1 minute is hard enough. So every game they get into the huddle, and the huddle takes longer than the actual play time because they're huddling and they're telling Johnny, you go this way, Jimmy, you go this way, and they're telling them everything they have to do in the huddle. Then they break the huddle. Then they come out of the huddle, and then the kids are always, they never go to the right spot. So the coach has to tell them to play in the huddle. Then he has to tell them to play on the line individually. No, you're going here. No, you're going here. And you have to hike it here, and you fake here, and whatever. And the kids never remember where to go. And then they do the play, and they try to run some flea flicker reverse, and the kids run into each other, and the ball drops, and nothing works, and the coach throws his hands up and goes, come on, guys, what are you doing? And I think, listen, keep it simple. Have the boys line up in the same spot every time. Very simple plays. Don't try to do anything crazy. Because, again, they're 7. That's not on the kids. That's on the coach for making things way too complex for 7-year-olds. Now, if the kids are screwing around, they're roughhousing, they're not listening, that's on the kids. Then give them some guff, I don't mind a little discipline here and there. So I think you can be annoyed with the misbehavior as a coach. Make them run wind sprints or something. I don't care. But if you're doing too complex of plays, that's on you, the coach, right? Same is true with financial advice. If your clients can't or won't follow good, simple advice, that's on them. That's misbehavior. But if you put your clients into complex strategies they don't understand, that's on you, the advisor. Get it? See, the advisor is the coach in this analogy, Duncan. Keep up. So, again, I don't want to do a deep dive in each of these strategies and say, well, here's the pros and cons of long, short, and market neutral, or reinsurance, or any of these alternative strategies. Managed futures. They can work in the construct of a portfolio if you know what you're doing, right? There's no one path to investing. But I think you have to be able to explain them and have a good reason for putting them in your portfolio if you're an advisor, right? Here's why every piece of your portfolio has a job. Here's the type of market environment these strategies will do well in. Here's the type of market environment they won't do well in. Here are the fees. Here's some historical context. Still don't understand or if you're comfortable with these investments? Okay, we're not going to put you in them. That's the kind of conversation we have to have. So I'm sure that they ran these through this perfectly optimized portfolio, but that perfectly optimized portfolio that the client won't stick with is essentially useless, right? So maybe the client should have asked more questions. In this case, Andrew here, I'm going to give him the benefit of the doubt, but the advisor here showed up with a 3-ring binder of plays, of flea flickers and reverses, and this client doesn't get it. And so that's my problem here, is that if you make things too complex for the client, then you've already lost, basically.
But now you wouldn't go as far as to say that you need to understand the mechanics of everything in your portfolio, though, right? I mean, sometimes it's fine. That's why you're hiring someone, right? You don't need to really understand everything that's happening.
Yeah, and some clients literally will wash their hands and say, I trust you, I have faith in you. I don't think you can ever I do think you can outsource some of that understanding. I don't think you can outsource it completely. I think you have to still understand, because the problem with these strategies is if you don't understand and have some context around them and understanding of why they're in the portfolio in the first place, the first sign of trouble, especially with something that's more complex, you're going to bail. Get me out of this. I don't want it anymore. It's underperforming. Why am I just not in the S&P and bonds or whatever? So I think that's the problem, that you have to have, if you're going to be more complex in your strategy, there has to be way more transparency and communication. It's not just trust us, we got this, because these things are going to act differently. That's the whole point of them. When they do, that's when people decide to give up on them.
And in that context, is a long short fund, they're talking about a hedge fund, right?
Yeah, long shorts, you can buy those in ETFs now, and that's the thing, is you can get a lot of these strategies in an ETF wrapper now, which is great you couldn't have done that in the past. But I think the advisor is probably on the hook here for lost communication skills.
Yeah, makes sense.
Put the kids all in the same colored wristbands, have them line up in the same spot every time. Make it easy. Don't make it too complex. Maybe I should be the coach now if I'm going to be
you
offering
sound
advice
like the
this.
coach. I think you should show them that intro clip of you scoring a touchdown and say, "I'm the coach now."
That's right. Relive those glory days.
There you go.
All right, next question.
All right, up next we have a question from Tim. Ben and Callie have been talking about how mortgage rates might not fall all that much if the Fed orchestrates a soft landing. My wife and I are in the market to buy a house. The opposite of not to brag. What should we do? Wait for lower rates or hope we can refinance down the line? We can't stand waiting any longer. I can definitely identify with this person.
Yes, you were in a similar spot, right? So she's only been our market strategist for a few months now. Hasn't been here that long. She's already getting questions by name. So let's bring her out. Callie Cox.
Hey, Callie.
Hey, guys. What's up? I'm glad that I finally got a question addressed to me. I feel so honored.
So I think we both came to the same conclusion that the strength in the U.S. economy is going to mean potentially more pain for home buyers going forward, or at least there's not as much relief as one would have hoped. So let's run through some of your analysis here.
Yeah, so you summed it up really well, Ben. And John, if you want to throw up that first chart, this is a stunning chart, but one that everybody could probably relate to, especially
Duncan, avert your eyes.
I know. I know. I'm sorry, Duncan. But
painful.
Yeah, Yeah, mortgage rates are around 7% now, 6.5 to 7%. And that combined with higher housing prices means the typical rate that we've seen on a 30-year mortgage, and we've done a lot of calculations around this, median sales price, average mortgage rate. There are a few assumptions that we're taking to get this, but the average or typical mortgage payment that you're seeing on a 30-year mortgage these days is more than double what we saw at the end of 2021. So you're not imagining it, is what I'm saying. Housing affordability has really gotten kicked in the teeth recently. And what Ben said is exactly right. I mean, it's great that the Fed is lowering rates and we could see lower mortgage rates. In fact, we already have seen lower mortgage rates, but I don't think they go much lower because for the Fed to cut rates drastically, we'll have to see a breakdown in the economy. And quite honestly, none of us want to see that because that means lost jobs.
Yeah, it's a tough situation. It's a double-edged sword. You want lower mortgage rates, but that's probably going to mean a slowdown in the economy.
This might be a super unpopular thing to say, but if you're just looking at the country and you're in charge of policy, isn't there some place where that makes sense, though, where like housing affordability has gotten so bad that it's actually worth there being a hit to jobs to level things out a bit? Or is it always jobs first and you don't care about housing?
Well, I think the panacea here is policy, what you just mentioned, Duncan. And I'm not a policy analyst. I mean, I think the simple answer is build more housing because everything is a measure of supply and demand. And right now, you're just not going to knock down demand unless you break the economy or unless you off a significant portion of millennials. And please don't do that. Coming from a millennial.
Yeah, but Duncan, it's a trade-off. That's the whole problem. Is a lot of things in the economy are built on trade-offs. Mm-hmm. You can't have everything be perfect all at the same time, and unfortunately, that means it's like a balancing beam, right? Where one thing's going to go up and one's going to go down, and that's the unfortunate problem. I think my theory is take the macroeconomy stuff out of it. I don't like timing the housing market. So my whole thing is if you find a house you like that you can afford and you can afford the debt service on it now. Not what you think rates will be. If you can afford it now, then buy the house.
Yeah,
Don't try to time it.
Completely agree, Ben. If you are able to refinance, if something does happen and rates end up moving your way, then that's just icing on the cake. That's
yes.
Something that you can cheer for if it comes under the right circumstances. But yeah, I agree. Houses are not an investment. I will die on that hill. It sounds like by the last line in your question that it seems like a good personal time to buy. We can't wait any longer. I would be curious as to why you can't. But if it's for personal reasons, go ahead and buy and just keep your budget in mind.
Peer pressure, or that's probably part of it. But yeah, I think you look at the refinancing down the line as a bonus. And guess what? There will be a time when you'll be able to refinance lower. That will happen for whatever reason. Something will cause a disruption in the economy. We'll probably see lower rates again. I don't know if we'll ever see 3% again. It's possible. You can never say never, but whatever, lower than 6.5%, sure. I think there will be a time when we see lower than 6.5%. You can't plan on the timing of it. That's the problem.
Yeah, I mean, the painful part, though, is you see that the house price from the last 5 years has doubled and mortgage rates are high or relatively high. So yeah, it just feels like a policy failure when you have a system where people are working, in a lot of cases, good jobs and still can't really make a house work.
The hard part about it is
failure.
It is a policy failure, but it's also like these circumstances that no one could have ever foreseen. We didn't build enough housing following the last crash because home builders were scarred. And then we pulled forward a decade's worth of demand in 2 years during the pandemic because things got so crazy. And so it was a combination of policy mistakes and just this weird confluence of the pandemic totally sped things up. And it to your point, it's a thing of, it's not like the people who didn't buy a house, like it was a bad decision on their part. They just got unlucky.
Right.
Yeah,
and
totally.
And to the homeowners in the audience that are watching are like, what are you talking about? We get questions every week from people who are like 30s, have great jobs, but like can't make a house work right now, can't like buy a house. Like
it
that's
is.
what we're talking about.
Yes, we have a doc full of these questions.
We're not talking about like
just like
20-year-olds out of college trying to buy a home,
Yeah, sounds like we should do a special show on it.
All right.
I like that.
Next question.
Okay, up next, we have a question from Ken. Currently, the Shiller PE is 37.2. It's only been this high twice before, January 2021 and at the height of the dot-com bubble. Should we be concerned with this indicator being so high? And can you do a cliff notes of what the Shiller PE even is for people who don't know?
Sure. John, show the chart first, then we'll discuss what it actually is. So this is from Robert Shiller's website. He plots it against interest rates, but this is, you can see, It's in the mid 30s, and it's really only been here twice before, the 2020s and then the dot-com boom at the end of the 1990s, early 2000s. So we are in kind of uncharted territory. Callie, how do you explain the CAPE ratio to people?
So the CAPE ratio is, sorry, I got distracted. The CAPE ratio is basically where the market is trading related to long-term earnings.
Yeah, it's like 10 years of inflation-adjusted earnings, and the whole point is to smooth out any cycles, and that's the point of it. I do think that people have been pointing out problems with this measure for a long time now, and it hasn't been a great timing indicator, obviously, because it's been elevated for a long time. I think the problem with people who use the CAPE as like the be-all end-all is anytime you use a single variable to dictate your analysis, or especially a timing thing with the market, it's very difficult. So we got a few other charts here. Mm-hmm. John, throw the next one out. I had our chart kid Matt do this one just for the forward PE on the S&P. It's definitely elevated. It's not looking nearly as bad. So this is just using the potential earnings over the next year, using analyst estimates. It's elevated for sure over the past, but it's not like completely out of the realm of possibilities over the last century, decade or so. One more from JP Morgan. The next one, this shows a bunch of different indicators, and it shows the 30-year average too. So it's PE and CAPE and dividend yield and price to book and price to cash flow. And all of these are elevated over the 30-year averages, but it's funny, the average CAPE ratio for the past 30 years is like 28. And if you look at the past 150 years, or however Robert Shiller, how far he goes back, it's more like 17 or 18. So it's kind of like what period is more important, 1871 or the past 30 years? And that's kind of the problem with trying to use these really long-term averages, is that sometimes the mean doesn't mean as much anymore when you go back that far and things have changed as much as they have.
Yeah, and things have changed a lot in the past 10 years, Ben.
Yes.
It's almost hard to look at the 10-year average because, put us back 10 years ago, we've gone through COVID, we've gone through the Fed, hiking and then cutting again and then hiking again. And we also, most importantly, tech is such a big part of the market now.
Yes.
Tech is understandably a big part of the market because their earnings growth has just been absurd, and we have the AI story behind it. But probably appropriately so, investors are willing to pay more for tech, and a lot has changed in that space. So valuation.
And those companies have higher margins, they have fewer employees, they have fewer. They don't rely as much on fixed assets as some of these older companies do. So it's a completely different ballgame now.
And huge competitive advantages. That's the other thing. These big tech companies are behemoths.
So
but I'm not trying to.
Sorry, show your chart with that shows X-Tech, because I think that's instructive too.
Yeah, and I'm not trying to excuse away valuation concerns, because this is one part of investing that you really need to keep an eye on. But if you strip out tech, if you strip out communication services, the two sectors in the S&P 500 that have these big tech companies, the valuations actually look a little bit more reasonable. When we say valuations too, we're looking at the expectations for earnings growth relative to the price that investors are paying for these companies. So this navy blue line is S&P 500 valuations without tech, without communication services. And as you can see, it looks a little more reasonable. Still quite high relative to the past 8 years or so. But I think tech right now, Ben, is more of or valuation is more of a tech story. Not necessarily everything is expensive, so I kind of run for the hills now.
The funny thing is that the conversation we've been having for the past 5 years or so is the stock market is overvalued. It's a bubble. I can't invest in it. And then you can kind of say, okay, well, small caps are cheaper and mid caps are cheaper. Even the equal weight is cheaper. Foreign stocks are cheaper. Emerging markets are really cheap. If you're really that worried about the S&P or the NASDAQ 100, invest somewhere else. And then people go, well, wait, those valuations are lower for a reason. Why would I invest in those companies? And so it's this you're running around in circles, I feel like, but that's the whole point. The valuations are higher in U.S. stock market because these are the biggest, best companies in the world, and they may deserve premium valuations. But you just have to ask yourself, can those valuations continue to rise and rise and rise forever, or should I maybe diversify and put some more money in these other areas of the market that are cheaper, even if it's for a good reason right now?
Yeah, and I'll add too that earnings are growing. It's hard to have a conversation about valuation when the E is going up, because that can lead to a lower P in the future. S&P earnings are expected to grow 10+%, not for the third quarter, but for the next 5 quarters. And of course, those estimates can change, but there could be some anticipation on behalf of that. The economy is growing a lot faster than, or, faster than expectations. So maybe the market does deserve a higher P because we think the E will go up. I think people try to look at valuation as a single number. And first of all, it's a ratio. You have to think about both the numerator and the denominator. But also, there are a lot of things pushing and pulling on it. So it's hard to base a market view just on where the PE is sitting.
Yes, and based on the CAPE ratio, people have been saying the stock market is overvalued for 15 years now. So again, that's the whole point of not using just a single variable to determine the relative attractiveness of the market. There's a lot of different things you have to look at when thinking about this.
Yeah, and I'll just sum it up by saying if you're worried about valuations, maybe it's a good time to look at your portfolio and understand where your investments are and which one of your investments is overvalued versus the others. Because if that's the case, then maybe it's time to, sell a little bit of tech, put it in a lower valued area of the market. I mean, these sectors and markets that Ben mentioned, international markets, small caps, mid caps, rate sensitive sectors, those unloved areas of the market over the past few years.
Good time to think about rebalancing. I agree.
I'm glad to hear you mentioned mid caps, Ben, because I got out of my zero coupon bond ETF and bought a mid cap ETF.
Okay.
Can I ask the reason? Indicator that I just couldn't live with myself losing money in a bond ETF. I was just like, if I'm going to lose money, it's going to be in equities at least. So, yeah.
Proud of you, Duncan, taking that
Fair.
risk.
All right. Speaking of investing mistakes, let's do another one.
Okay. Up next is a question from Akshay. I'm an immigrant in Canada, started a new life in Toronto around 4 years ago. Seems like I've made a couple of bad decisions and wasted around $20,000 trading Forex, crypto, options, and whatnot. Forex is the thing you see the most like scams on Instagram about.
Foreign exchange, yes,
Yeah.
That's true. I think there's been a few Instagram ads saying Ben Carlson wants you to trade Forex with him.
Right.
Not me.
Easily confused because you are big into it, but
Yeah.
No, I'm just kidding. Okay, back to the question. It's hard to accept this truth in front of your spouse, having all the knowledge in finance and making dumb mistakes. How do I overcome that guilt?
Really good question. I feel like we've had a lot of questions about NVIDIA lately and what to do with huge gains, so it's kind of refreshing to get the other side of the equation. But this guy is not alone here. Like, this happens to everyone. Everyone pays their tuition to the market gods. I think the good news is that he realizes, okay, this is not for me, the speculation. I think there's a lot of people some people have the personality to speculate and they have the ability to lose money and they just get over it quickly, right? They can move on. Okay, that was a trade. I'll try to get the next one. Some people, it stays with them forever. I guess the whole point is at this stage, it's a sunk cost, right? That money is not coming back. Don't try to revenge trade and get it back. But now just admit to yourself and look in the mirror, okay, this isn't for me. What is a good strategy for me? What better aligns with my personality? And then maybe you bring your wife in and talk to her and try to understand what kind of stuff her risk profile looks like and get some help and just say, listen, I made the mistake. We're moving on. It's a sunk cost. Let's get better.
Yeah. Can I just say, whoever wrote in, I am so proud of you for actually investing and, trying to learn this whole speculation thing. And that's not me making a statement on, short-term trading versus long-term investing. I think sometimes we forget that the majority of Americans, or around 50% now, don't invest money, period. They don't even dip their toes into the markets. They don't even, really engage with what's going on. So the fact that you are doing that right off the bat is a step forward in my mind. That's a W. Don't think of this as an L. There isn't a W there. And look, Ben is right. We've all gotten hammered by markets in one way or another. I mean, I'll be honest. I bought Peloton in mid 2021 because I'm a big Peloton fan.
Who hasn't bought Peloton at some point?
I know, but I'm still holding the bag with Peloton down near $5.
You use the bike and you think how can this not be a bigger thing, or how can someone not come in and buy them? I had the same. I never bought the stock, but I had the same feeling.
Right. It probably went in your too hard bucket, Ben, which I commend you for that.
Listen, I've written extensively about investing in IPOs and how dumb it is. And I mentioned on Animal Spirits this week, I bought the Airbnb stock at the IPO, and the stock has just gone nowhere ever since. So it cost me a ton of money in missed gains elsewhere that I could have just been indexing or whatever. And so I think everyone does this. So I guess it stinks to look back and say what could have happened with that money. But now it's fresh slate. Move on. Find a strategy that works for you. Maybe it's taking your hands off the steering wheel a little bit more and more set it and forget it. But again, it's a sunk cost. feel bad about yourself, learn about it, move on. Don't like kill yourself forever over this.
It's good they're admitting it too, right? A lot of people
Definitely.
you see in finance are super stubborn and won't ever admit when they've made a mistake. Admitting you made a mistake, I mean, that's commendable to
Yes.
me.
He's not blaming the Fed, so that's good, right? He's not like blaming someone else. He's saying, listen, I made a mistake. I tried to speculate and buy options and Forex and crypto and all this stuff, and it didn't work for me. Now you know what don't works for you. Figure out what does.
Also,
Yeah,
I
and
mean,
don't
how
be
much
too
of the
hard on
market
yourself.
is luck? I mean, how much of life is luck, I guess, but how much of if Overvalued went to $10 on an acquisition, I mean, I would like start a newsletter about investing, you know. That's how life works, right? But instead it's down a lot, you know. That's life.
So hope is a strategy for you. Is that it, Duncan?
I'm just saying a lot of the stuff, a lot of what makes like people massive winners in the market is people taking risks that aren't necessarily the wisest risks.
Yeah, you're right.
But
It's
when they
outcome
work, they look
bias,
genius,
right?
you know.
Survivorship bias. We hear about the lottery ticket winners. You rarely hear about people like this who tried to win a lottery ticket and it didn't happen for them because not as many people will admit it. They'll just kind of quietly sweep it under the rug and try to go for something else.
Yeah. I would just end up by saying don't be too hard on yourself. We've all done this. Just be proud of where you are, consider it a sunk cost, and look, you
And
have
when you
better
talk to
days
your
in
wife
front of
about
you.
it, blame Jerome Powell. Listen, if Powell wouldn't have stepped in and messed up interest rates, I would have made way more money. Right? Blame it on him.
I mean, Jay Powell just flipped a coin, you know.
Yeah, I bless him. All right, one more question.
Okay, last but not least, please help settle a disagreement my friend and I are having. He says he'd rather the stock market only go down a little bit and then go up a steady amount every year during his working years because recovering from a 30% drawdown on your current portfolio would be difficult. I would rather buy shares on sale. I'd prefer the market to be down 30% for the next 5 years, which will allow me to obtain shares at a discount. Then when I retire, have the market rip for the next 10 plus years. Can you help mathematically prove which scenario makes the most sense?
I love the fact that we have friends who are having stock market disagreements. Like, Callie, these are our people here, right?
I know. I feel the love, fellow market nerd.
That's from
Yes.
Greg, by the way. But yeah,
So
thanks, Greg.
the way that I look at it is there's different risks to different investors depending on where they are in their investing life cycle, right? So we've made 42 or 46 new all-time highs this year for the S&P through Monday. I think. Does that sound right, Callie?
Yeah, that's about it.
That's a lovely environment if you hold a bunch of financial assets. Like for baby boomers who have been investing for decades now, this is wonderful for them. They just want to keep seeing the stock market slowly but surely go up. But if you're a young person, seeing all-time highs like this every day and you're going to be a net saver for decades to come, this is not necessarily the right environment for you as a saver. You should want to see volatility so you can buy stocks at lower prices. You should pray for bear markets so you can buy stocks on sale. So obviously the whole sequence of return things, to Duncan's point about luck, you can never get this exactly right. Like some people retire at the peak in 2000 or in 2007 and they're unlucky, right? So you can't ever time these things, but I actually did run some numbers for this. So I want to run through the example on this. So John, throw the first chart up. I just did this simple scenario where different sequence of returns that get you the same annual return. So over 10 years, I did this drawdown scenario where each year for the first 5 years, you lose 15%. So that's a drawdown of like 55% in the first 5 years. And then the back half of the decade over 5 years, you gained 40% per year. And the other scenario, you just gain a steady 9.1% per year. So in both of these scenarios, you get 9.1% average return annualized over 10 years. It's just that the path to get there is different. So of course, by year 5 in the first scenario, you're doing way, way worse. So I just decided, like, what if you just invested $10,000 a year at the beginning of each of these 10 years? So John, do the next chart here. Over the first 5 years, you're doing way better under the steady state scenario. But you end up with double the money after 10 years in the drawdown scenario because you're investing a ton of money in those first 5 years when stocks are down, and then they play catch up in the back half. So if you're a young person, Greg here, he's right. He can tell his friend that I bless him. He won this argument. You want to see bad years early and good years late. That's the scenario that you want to see. If you're a retirement person who has money already, you want that steady state. You don't want the volatility because you don't want to be taking out money out of the stock market when stocks are down. Obviously,
Yeah.
the real world doesn't work like this, but that's the idea that you want to see drawdowns early in your life when you are saving and putting money into the stock market.
Yeah, and Ben, this kind of reminds me of the lump sum versus dollar cost averaging argument. Because obviously, well, not obviously, but I think Nick Majuli ran the numbers. I mean, 80 or 90% of the time, it's best to put all your money in the stock market and just wait. but we're humans, right? Like when I read this question, my first thought went to, well, the math probably favors earlier investing all at once, but like we have emotions. There's a psychological aspect to this too.
You're right. If you live through a 55% crash in the first 5 years of investing, you probably say, "See you later. I'm out of the stock market forever." Right? It mathematically that's the right decision, but how many people gave up on the stock market for years following the 2008 crash because we did crash that much?
Yeah, and there are two sides to it too. There's, do you trust yourself to buy in a 30% drawdown, and do you trust yourself to keep holding stocks if it rips on the other side? Especially, I don't want to nitpick, but in the question it did mention retirement. So I was like, oh, and then you're living off your portfolio, so it's even harder. But my math that I'm bringing to the conversation, Ben, is you have to remember bear market math. A 30% drawdown is a 43% rally to recoup. So if you think about the S&P's average move, per day, it's like 4 basis points. It's teeny tiny, but that means that you recoup it in like 4 years or so. So you don't necessarily need to take a ton of risk on both sides. I know this isn't the answer to the question, but if you're trying to apply this to your own portfolio and investing strategy, just remember that you don't necessarily need to hit that home run out of the park. And sometimes it is better for your sanity not to.
There was this old Peter Bernstein quote where he said something along the lines of, "The market doesn't provide high returns just because you need them." So the whole point of trying to get, like, if the market just does this for me and then it does this for me, I'm going to be great. And that's the problem with sequence of return risks. What I showed, the path to get there, especially if you're a saver or withdrawer, like if you just have a bucket of money to the lump sum thing, if you have $1 million on day one, how you invest is going to be very important. But the path to get there matters a lot more when you're putting money in constantly or taking money out constantly. And that's why that's what I said. There's different risks to different investors depending on what stage they're in. And that's one of the big questions we get from retirees too, is the sequence of return risk. Like, what if there's a huge bear market right when I retire? And that's why you need to have other assets and diversify to plan for these outcomes. Like if you have all your money in the stock market, you could be just fine, but you don't want to be selling stocks when they're down 30 or 40% because now you're locking in losses.
Yeah, that is absolutely something you want to avoid. Like I know that there are a lot of ways to get to one goal, but selling when you're in a bear market is like one of those things that you just can't tolerate.
And if you have to sell, you can just do some tax loss harvesting, right?
Yeah, everything is a trade-off, Duncan. That's a trade-off I don't want to make, though.
Yeah, that's the one thing it seems like you guys have proven time and again is the worst thing you can do is, like, in that first drawdown, just get out of the market and stay out of the market for years. That's not a recipe for success.
Yes, right. but yeah, that is why this is totally hypothetical, because to your point, Callie, like it would be easy to look back at any of the previous crashes and go, oh, if I would have just kept putting money in, I would have been golden. But how many people actually had the fortitude to do that? Not everyone.
Yeah, and I also think that people forget, and I'm saying this as somebody who was a teenager during the financial crisis, when you have a true crisis that really like punches you in the gut, you feel it all around you. It's not just in markets. God forbid you lose your job. There's just a lot that happens outside of your portfolio that makes it even harder to kind of do the right thing or buy the dip.
Right, to make it harder for you to keep those contributions coming in, right? Make it harder to save, and I agree that.
And did you buy any individual stocks in 2008?
No, I kept funneling money into my 401k. The biggest thing I remember is I was just starting out saving and investing then. So for me, I knew it didn't matter. Like if I keep putting money in, if I'm losing 50% on whatever, few $1,000s I had in, it didn't matter. So I just kept funneling in. But I had a colleague who said, I'm putting all of my money, all of my 401k contributions indefinitely into the money market fund because I'm worried the financial system is going to collapse. And I thought, well, if the financial system collapses, I've got bigger things to worry about. So I think I'm going to keep buying stocks. But that point in my life, I didn't have any other responsibilities. I didn't have a house. I didn't have a family. I didn't have all these things. So I could take that risk. Some people won't feel comfortable taking that risk in that time because they have other responsibility. He had a family. He had just had a new kid and all this stuff. And I think that was part of the thing that colored his mindset there. So it was a terrible investing mistake. But I think to him, he was thinking, I need to take care of mine now and be a little safer with this. So you can't always think in terms of just market risks in those scenarios.
Yeah,
I was in college and I bought Microsoft, Seagate, and weed stocks. And the weed stocks are all out of business. But Microsoft and Seagate did well.
I remember
when
when
VC
weed
portfolio,
stocks were
Duncan.
really hot. Yeah. Right around the time I joined the industry in 2013, I feel like weed stocks were like hitting their peak. And the only reason I say that is because I was a reporter and I think we ended up trying to hire for a marijuana stocks reporter. And that's like crazy to think about 10 years later.
Niche.
I know, but that's how hot they were, and that's how much interest was, around weed stocks. But anyway, I was in high school during the great financial crisis. My parents lost their jobs, so I definitely felt it. But it is something I think about. I've never been an investor during like a punch in your gut type crisis.
All right,
Not to
Callie.
brag, you're the youngest person on the show. You just let everyone know.
That's
Thanks.
right.
Made me feel really old. Callie, tell everyone where they can go find your weekly newsletter.
Yeah, well, it was such a pleasure to be on here. You guys are so much fun. You can find me on OptimistiCallie. It's a newsletter through the compound. Sign up. You get hot and fresh insights every Monday morning.
Great charts, great insights. We appreciate it. Askthecompoundshow@gmail.com is our email here if you have any questions. We feel sorry for all the people who don't get to their questions. We have so many of them that come in.
One
but
day.
Yes. We read them. We keep them. It'll be in storage someday. Thanks to everyone in the live chat for listening. Thanks for everyone on Twitter. Remember, if you have a question for us, you can reply on YouTube. You can send us an email. And we'll see you next time.
See you, everyone.